Hello and welcome to today's video. If you are new to the channel, we would like to say thank you for taking the time to check us out. And as for my Farmer Capital family, welcome back. Sit back as we dive into the world of student loans, a world that currently holds more than $1.7 trillion in the United States alone. It's a staggering figure, isn't it? But don't let it intimidate you. Understanding the ins and outs of student loan repayment options can be your lifeline in this vast sea of debt. For many borrowers, repaying student loans can feel like an uphill battle, with the summit often shrouded in clouds of confusion and uncertainty. But here's the silver lining. You're not alone in this struggle. Millions of people are in the same boat, navigating the choppy waters of student loan repayment. And the good news? There are various repayment options available, tailored to different financial situations and income levels. By arming yourself with knowledge about these options, you can turn that uphill battle into a manageable journey. With the right knowledge of repayment options, you can navigate this world with confidence. We begin with the standard repayment plan, a straightforward approach with a 10-year fixed payment period. Let's dive a little deeper into this plan. Picture your student loan as a journey, and the standard repayment plan is the most direct path from point A, your debt, to point B, being debt-free. This plan sets a fixed monthly payment amount for a decade, providing a clear roadmap for your financial journey. Why is this significant? Well, it's all about predictability. With the standard repayment plan, you know exactly how much you owe each month, making budgeting a breeze. There's no guesswork, no surprises, just a steady march towards financial freedom. But there's more to it than just predictability. But before we move on, if your goal is financial freedom, do check out our video. What is financial freedom and how to achieve it? It's packed with value and comes with a complete article on how to go about becoming financially free. Now back to the topic. The standard repayment plan can also save you money in the long run. Yes, you heard it right. Since the repayment period is shorter compared to other plans, you'll end up paying less in interest. It's like taking the express train, faster and more efficient. However, it's important to remember that while the standard repayment plan has its perks, it also requires a higher monthly payment. This could be a hurdle if you're just starting your career or if your income is on the lower side. It's like choosing a route for a road trip. The direct route might be the fastest, but it might not be the most scenic, and it might require more fuel. Similarly, the standard repayment plan might get you out of debt quicker, but it might require a larger chunk of your monthly income. So, is the standard repayment plan right for you? Well, it all depends on your personal financial situation and your long-term goals. The standard plan offers predictability, but it may not be the best fit for everyone. So it's crucial to weigh your options and choose the plan that aligns best with your financial landscape and future aspirations. Transition to income-driven repayment plans, a saving grace for those with tight budgets. Now let's delve into the nitty-gritty of these plans. Income-driven repayment plans, as the name suggests, base your monthly payments on your income, not your loan balance. It's all about making your student loan repayment manageable and less burdensome. Imagine this. You've just graduated and you're at the start of your career, perhaps working an entry-level job. Your income might not be as high as you'd like it to be. In such a scenario, an income-driven repayment plan could be your knight in shining armor. It takes into account your income, family size, and state of residence to calculate a monthly payment that's affordable for you. The cherry on top? These plans offer potential loan forgiveness after a period of 20 to 25 years. That's right. If you're still paying off your student loan after this period, the remaining balance could be forgiven. It's essential to keep in mind that while these plans can significantly reduce your monthly payments, you might end up paying more in interest over time. But remember, the goal here is to make your payments manageable, especially in those early years of your career when your income might be lower. The federal government offers 4 types of income-driven repayment plans. Income-based repayment, IBR, pay-as-you-earn, pay, revised pay-as-you-earn, repay, and income-contingent repayment, ICR. Each has its own specifics, but they all aim to ease the burden of student loan repayment. Income-driven plans can be a lifeline, particularly for those with fluctuating or lower incomes. So, if you're feeling the pinch of your monthly student loan payments, it might be worth exploring these options. Introducing the graduated and extended repayment plans, 2 more options in the repayment toolkit. Let's dive into the details of these plans. The graduated plan is like a stepladder, starting with lower payments that incrementally increase over time. This plan is designed for those who expect their income to grow, allowing them to handle larger payments down the road. However, keep in mind that the total amount paid over the life of the loan may be higher compared to other plans due to the additional interest that accumulates during the initial period of lower payments. On the other hand, the extended plan offers a different approach. This plan stretches the loan repayment period to 25 years, reducing the monthly payment amount. It's like taking a long, scenic route, allowing for smaller, more manageable payments over a longer duration. However, this plan doesn't offer any forgiveness, unlike some of the income-driven plans we've discussed earlier. And similar to the graduated plan, the total amount paid over the life of the loan can be higher due to the prolonged interest accumulation. So which one is right for you? Well, that depends on your individual circumstances. The graduated plan might be a good fit if you're confident about your income growth. The extended plan, on the other hand, might be the better choice if you need the lowest possible monthly payment and you're okay with a longer repayment period. Remember, it's not a one-size-fits-all situation. Each plan has its unique features, and it's important to evaluate your financial situation, your income stability, and your long-term financial goals before making a decision. Both the graduated and extended plans offer flexibility, but they come with their own pros and cons. Let's shift our focus to prepaying loans, a strategy that can save on interest. So what exactly does it mean to prepay a loan? Well, it's as straightforward as it sounds. You're essentially paying off your loan faster than your regular repayment schedule. This can be done by making additional payments or by increasing the amount you pay each time. Now, why would anyone want to do that? Isn't it better to have more money in hand now and worry about the loan later? While that's a natural way to think, there's a huge advantage to prepaying your loans, especially under the standard plan. The magic word here is interest. The quicker you pay off your loan, the less interest you end up paying overall. Let's paint a picture, shall we? Imagine you have a loan that you're supposed to pay off in 10 years. If you stick to the regular schedule, you'll be paying a certain amount of interest over those 10 years. But if you start prepaying your loan, say in the 5th year, and manage to pay it off by the 8th year, you've just saved yourself 2 whole years of interest payments. That could be a significant amount of money. However, it's not all sunshine and rainbows. Prepaying loans requires a careful balancing act. It's important to consider your overall financial situation. Do you have enough savings for an emergency? Are you able to meet your other financial obligations? Prepaying your loans should not put you in a position where you're struggling to make ends meet. In short, prepaying loans can be a powerful tool in your financial arsenal. It has the potential to save you a considerable amount of money in the long run. But like any financial strategy, it requires careful planning and consideration. Prepaying loans can lighten the load, but it requires careful financial planning. Let's wrap it up. We've navigated through the labyrinth of student loan repayment options, each with its own unique features. The standard plan, a 10-year journey with fixed payments, ultimately leading to less interest paid. The income-driven plans tailored to your income, offering relief with the potential for loan forgiveness after 20 to 25 years. The graduated plan, starting with lower payments that gradually increase over time, and the extended plan, stretching your payments over 25 years. And let's not forget the option of prepaying loans to save on interest, particularly under the standard plan. Remember, these are not one-size-fits-all solutions, but tools to help you manage your debt. The right choice depends on your unique circumstances, your income, your lifestyle, your financial goals. We have put together more on the topic in a complete detailed article. We'll leave a link to that information in the description box below. Thank you for joining us on this detailed quest. If you have any further questions, please comment below. And don't forget to subscribe for more videos like this one. Check out this video next.